Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me as part of our 2020 87th STA Annual Market Structure Virtual Conference is Doug Clark, Managing Director, Americas, Head of Market Structure at Credit Suisse, to discuss how liquidity has shifted in 2020. Doug, it's great to have you. Welcome to Trade Talks.
Thanks very much, Jill. It's great to be here.
And Doug, how has the growth in retail investing changed the liquidity landscape?
You know, retail's been the great story of this year. We've seen the various platforms see new investors, and it's been fantastic to see greater involvement of younger people within the markets. But it's also shifted when trading's happening and where the trading's happening. So in the US markets, trading by retail, particularly smaller trades, those that are under, say, 5,000 shares, are typically sent to wholesaling firms like a Citadel, and they will offer guaranteed execution with price improvements to the various retail platforms, the Robinhoods and the Schwabs. Terrific for the end investor, but those trades, because of the way they're handled, they're not necessarily accessible to the institutional investor, which is fine, not a big problem for everybody, as long as the institutional investor is able to understand the impact of that on the volume that is accessible to them. As we've seen retail have such a phenomenal growth spurt this year, what has happened is the so-called TRF, which is the trades not done on exchange, have gone from, say, 30 to 35% of total volume to north of 45% some days. That TRF is made up of two components. It's the OTC portion, which is this wholesaler trades and a few other things, but mostly this retail trading, along with dark pools. The OTC portion of the TRF has actually become a bigger part of the TRF. So overall, what we've seen is the accessible portion of volume has become greater, and that's frustrating institutional investors. They are trying to buy a stock, they see 3 million shares traded, and they don't understand in real time what percentage of that is volume that they can interact with versus volume they can't. And it's really name by name. As names become mentioned on some of the blogs, whether it's new folks that are just into the marketplace or, you know, a popular host on CNBC or any of the other business channels, retail will quite often get very active in that name, and they can at times be 40, 50, 60% of the volume. In other names, maybe they're only 20%. So it's confused the market a little bit as they try and understand what volume they can trade with, and as they understand what percentage of volume they can be without having undue impact on the market. It came up at the STA conference just today. One of the SEC commissioners, Commissioner Roisman, was suggesting that we take this TRF volume, this sort of 45% of volume right now, and we turn it into two separate groups, one of which is this dark pool ATS volume that the institutional crowd typically can transact with, and the other would be this OTC volume that maybe they can't transact with. So in real time, they can understand what is the volume that I can trade with, and therefore they're not being 15% of volume and thinking that's an okay, but they're really 30% of the tradable volume and having undue market impact. The other thing that we see is retail tends to trade very early in the day. They like to trade first thing in the morning. They're a little heavier during the lunch period, where maybe they're getting a break from work and they're having a chance to sign on to their brokerage account and trade. The institutional traders, for various reasons, tend to trade towards the end of the day. They may have just got some inflow of cash and they're now trying to get that into the marketplace, or they have some outflows and they've got to raise cash to send money to their investors. So there's a dislocation of when they trade in the day. So even if retail is 25% of volume in a name, they may be 35% in that first half hour of the day. They may be 18% in the last half hour of the day. So this would also just make it easier in real time for traders of various type to understand who's trading what and what they can interact with.
How does the street continue to adapt to high-priced stocks with very wide spreads?
Yeah, I mean, we've seen particularly some of the Nasdaq listed names, the tech names like Google. Google right now is trading $1,400 to $1,500. The average trade size in the name is 30 shares. And so that's a little confusing. The quote that most people see on your favorite website or even on a Bloomberg or a Reuters terminal is the best quote that's available for 100 shares. The average trade size is 30 shares. So you have these spreads that are actually wider than what is really available in the market for smaller trades. There is a tighter quote there available for what we call odd lots. So the street is trying to interact with that. They're also trying to figure out how to trade within that quoted spread more often. We've seen a number of order types that we call intra-market order types or offset pegs rise up. Nasdaq's actually done extremely well on that side, probably is better than any of the lit exchanges in creating new order types and garnering share. And so the institutional community's just become a lot smarter this year, particularly in March, when spreads went from already wide on some of these names to extremely wide for about a month while the market went through its volatility. Nobody wants to cross a spread when it's 50, 60, 70 cents wide. You want to do your best to try and get something in between the bid and offer first, and only cross the spread as a last resort. So we've seen a lot more effort and research put into how to do that effectively this year, and we think that's going to continue on even as volatility comes down. It's been mitigated a little bit by a couple of stock splits, and if we had more of those, we would certainly see that. But it's just become how to more intelligently access liquidity within the bid offer instead of just trading out the bid offer.
Yeah, and Doug, another big story this summer, of course, has been stock splits. Now, how has that impacted trading?
Yeah, stock splits, the street has long been asking for it. NASDAQ, your chief economist, Phil McIntosh, has been writing about stock splits for a long, long time. And, you think about this Google example that I mentioned, it has an average trade size of 30 shares or so, but the quote is only good for the best price of 100 shares. As you split a stock, that average trade size goes up and the quote becomes a little more real. What we've seen with the two stock splits with Tesla and Apple, the value traded, the volume traded didn't really change a whole lot. There was a pop in activity just before the split happened. So from the time that Apple announced their split to the time that it actually happened, you saw increased activity in the name. You saw both stocks had a bit of a run up for sure, but they have been running all year. So tough to really say how much of that was due to the announcement. But post the split, there was a bit of a sell-off in tech names in general, which was not to do with the split, but they're trading the same sort of volume and value they were trading before the announcement. But that quote that you see for 100 shares is more indicative of what the real market is. There's a little less need to try and find clever ways to trade in between the spread. So you just get a bit of more of a truer, more meaningful quote. And what you see is retail becomes more interested. There is a bit of a behavioral bias on the retail side. If they're going to own $10,000 worth of a stock or $20,000, a lot of people like to own 100 shares. It feels more meaningful than owning one share, even if the dollar value's there. So you open yourself up to greater participation from those folks that have that behavioral sort of tendency to want to own a round number of shares as opposed to a single or three shares.
All right, Doug, and to wrap up here, a higher level industry question. Now that the industry has learned to operate in a virtual environment, do you think that's something that's here to stay, or we might see more of a hybrid environment going forward?
Yeah, I do think we'll see a hybrid environment. I personally, in my role, have tended to travel a lot, and I still want to get in front of clients. I still value the face-to-face. I think those meetings where you build relationships and you create a bond, you get a better understanding of the other person's challenge or ideas. But I think we're going to do it a lot more effectively going forward. Instead of going to New York 10 times a year, probably do it 3 or 4 times. We'll use things like Zoom. Even the 50-year-olds in the room have learned to use this technology. So it's the way forward. We'll do that, but I still think that there's going to be some need to have face-to-face for internal meetings. It's important for mentorship, for development of staff. It's important for client development and relationship development. And even amongst our peers, it's important to get together once in a while and kick around ideas of how to make the industry better. You just have better conversations face-to-face, but I think we'll save it for when it's necessary, as opposed to every meeting's got to be face-to-face, and we'll value it a little bit more going forward.
Doug, agreed on all points. Thanks so much for joining us on Trade Talks.
Thanks, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.